Keith Bliss is on the floor of the stock exchange. He's a senior vice president at Cuttone Co. Keith, what is your reaction to how the market is open so far?
Well, it's actually something that we expected to have occur yesterday, and the fact that the Chinese government didn't step in with some sort of policy measures and calm the markets led to that additional sell-off, really dramatic sell-off that we saw yesterday. So the market reaction here is to be expected. When you have markets that get stretched so far one way or the other, like most things in life, they have to revert back to a mean. So the pop here is well-intended, well-focused. People will step in and buy. The fundamentals of the market, even if you believe that they've been inflated by policy maneuvers, both here as well as overseas, are still intact. And I can see this market actually rallying back up to be positive for the year. We have to have a few things happen. The amount of technical destruction that occurred in the markets was pretty substantial over the last 2 days. But again, we've never seen momentum indicators and relative strength indicators as weak as they are right now, except if you go back to the Black Monday crash of 1987. And if you recall back then, it took us a couple of sessions, but we rallied pretty hard from there and set off on a multi-year bull market from there. So I'm not suggesting that we're going to reach higher highs here in the near term, but we'll certainly trade back to what I believe will be a positive level for 2015 here in the next few sessions.
So Keith, what about the near term here? As you look at the rest of this week, for instance, a lot of people were spooked by what happened yesterday, feeling as though they needed to take action very quickly. What is your sentiment going into the rest of this week?
Well, again, I think it's certainly I have a positive posture as I look at the markets. We're still vastly oversold, and that's a technical term again when markets get stretched too far to the downside. And you're going to see buyers like we're seeing today. They'll continue to step in and buy some of these great values that have now been created from these large sell-offs. When you got companies like Verizon or Walt Disney World, or even some of the new media companies like Netflix, which are so overdone to the downside, you'll see them come in and catch a bid, and buyers will re-enter the market. I feel bad for people who panicked on Friday and Monday and decided to sell into that sell-off. Now they're out of pocket, out of money, and they're not going to participate when this market rallies back up. I recommend to everybody, if you're a long-term investor, you really shouldn't look at these market gyrations. They're going to happen because of the way things are structured inside of the global economy right now. You're going to get these convulsions every now and then. Lots of policy changes are afoot here in our country. We're now contemplating raising interest rates, even though they'll be modest. That will provide some sort of catalyst inside of the equity markets, which will provide those spasms or convulsions. And you need to just get to the side and not worry about it. Longer-term investors should do that. Shorter-term investors and some of the more active participants, the professionals, they'll be trading inside of this market. We like volatility. It creates great profit opportunities either on the long side or the short side. So we'll move the markets around a little bit. But again, for people who are watching this at home, I recommend that if you have, of course, depending upon where you are in your own timeline, your own life horizon, if you will, you should really be more thoughtful and patient with what's going on here in the markets, and they will revert back to a mean and things will calm down eventually.
And Keith, ultimately, how much of an impact could China have on our economy, and is the U.S. economy at any risk of recession?
I don't believe I'll answer that in reverse. I don't believe at this juncture the U.S. economy is at risk of recession, even though the growth has been pretty slow up to this point. We're all disappointed with the way the trajectory of the U.S. economy is tracking right now. All the economic indicators and data that we look at don't point to an imminent recession at all. China, of course, given its position inside the global economy today and what it does inside the economy, China is well known to be the manufacturer to the world and the supplier to the world. If they start to have some slowdowns, which it seems they're starting to get some cracks inside of their economy, it will be a little bit troubling because they are also not only great suppliers of goods to the rest of the world, but they're also great consumers of some of the larger commodities like copper, like oil, like gold, any of the industrial metals that they're doing. And we do depend upon their place in the economy. I think what spooks people about China as it relates to the U.S. is, make no mistake about it, despite any kind of political backbiting that may occur between the two countries, China and the U.S. are business partners, and that's absolutely true. They own a lot of our debt. They do buy a fair amount of our goods. They're our third largest trading partner for imports into their country from this country. And of course, we buy a lot of their goods. So we're very concerned what they're doing with their economy. It needs to remain on a stable footing. It could have some impact. Longer term down the road, it could have a negative impact and real negative implications inside the U.S. economy, but I think we're a long way from that occurring.
All right, Keith Bliss of Cuttone Co. Thank you so much for your insight.